Good evening, everyone. Thank you so much for joining us this evening. We have our trading expert with us, Mr. Michael Grobler. Today, we're going to be discussing a range of topics. If you have any questions, please feel free to just open your mic and chat to us. Alternatively, drop your question in the chat and I'll refer to it whenever we get a gap. All right, so a little bit about Michael. Michael, can you tell us how long have you been trading, more or less?
Hi guys, thanks for meeting us so late on a Friday. You must be a very diligent lot. Yeah, I've been trading for many years since I was quite a young boy, and sort of second time now that this trading game has taken place through Varsity College, and just want to help you guys out, see if there's anything you might need to know, general questions about the process, the markets, anything you might be confused about. There's no such thing as a stupid question. And yeah, I just wanted to avail ourselves here, help you out, get you confident enough to make the trades you need to make to win the game, win the money, and hopefully the bug bites and it's something that you're able to enjoy for the remainder of your life. Just a bit of context on the markets at the moment. We've got oil prices rallying for quite a sustained period of time. We've got equity prices rallying for quite a sustained period of time. We have a lot of inflation-linked assets that are rising quite quickly. There's been a lot of money printing in the last few years as a result of COVID. And I think that some of those chickens are coming home to roost. You might feel it in your pocket on a daily basis. You see it in property valuations globally. So you've got a lot of this sort of effect of a lot of liquidity in the system that's impacting markets. So it's actually been quite a great year for markets in general. Let's hope they continue that way for the sake of the competition. But things could get choppy and make it even more interesting. So yeah, it's been a great year. And it's always a great time to get involved in markets, but I think that if you can thrive in this sort of environment, then you probably set when things calm down a little to you shouldn't have too many problems as long as you learn the fundamentals and the basics of the process. It's a very scalable learning process. You can invest. We have very inexpensive local platforms, real life platforms available like Easy Equities, where you can invest as little as 10 Rand in a share. So you can enhance your exposure to markets and different instruments and different countries, things that were never available to us when I started trading. We used to phone in our trades. Now, for no cost, you have access to American stocks, bonds, commodities, ETFs, derivatives, options, all from South African-based platforms. So this is a wonderful stepping stone to see if you can see how you enjoy the feeling of the market, how it makes you feel. And Megan's done such a great job in replicating a very reflective experience, and so you can get a sense that if you're able to do the process with this platform and maybe succeed and do well, and even if you don't do well, even if you do badly, I'm sure you'll have learned a lot of things. So it's a fascinating game, and like I say, the college has done great to give you this opportunity to get involved and even win money.
All right, so just to kick off, Keenan has asked about pump and dump schemes. Okay, very interesting. Okay, so for those of us that don't know, Michael, can you tell us a little bit more about these pump and dump schemes?
So pump and dump schemes are basically they're like marketing campaigns. They take a situation where a company or an individual buys a stake in a small low liquidity company on the stock exchange. The reason why they choose those businesses is because the liquidity is low on the company. It's easy for them to manipulate the share price more than they would be able to for a large stock. Like you could imagine, it'd be very difficult to move the needle on the Apple share price or on the Microsoft share price. But if you go to a small cap South African stock like Renogen or Purple Group, very small market caps of only R1 billion or so, those companies will they'll be subject to pump and dump schemes on occasion. Basically, what they do is they buy the stock before you do, then they motivate hundreds or thousands of people to buy the stock, driving the demand for the stock up, driving the stock price up, and then they sell the same stocks that they bought initially to the future buyers, and they end up being called bag holders because they left holding the bag. So it's not a very nice way of doing it, but I mean, a few months, if not weeks, in the market, and you'll recognize that kind of thing. You can also simply just stay away from it by involving yourself in high liquidity companies. We have many of those in South Africa. We have some of the most epic companies and CEOs in the entire world that come from South Africa. These companies come out of South Africa versus coming out of Europe, which are like business utopias compared to this place. Once you thrive here, our businesses can go all over the world and dominate. So it's really an incredible place. It's also an incredible stock market that we have here. We have probably the largest futures market in the world, believe it or not. We have an incredibly liquid currency, highly traded globally. We've got an extremely varied group of stocks on our stock exchange that are subject to enormous levels of volatility. It's a wonderful practice arena. I personally started here. Then you start buying American stocks eventually, or you might start buying European stocks, and it's just the most chilled out place compared to our market. So I'm really blessed that I got to start here, because if you can make it here, you can make it anywhere. And it's but I mean, avoid the pump and dumps, and avoid obvious problem situations like that, where you can see that there's a motivation outside of fundamentals to make the stock rise. People could argue this is the truth of many assets. Bitcoin is certainly subject to pump and dump. Doesn't mean that the underlying asset doesn't have some kind of use or value, even if it's just speculative. But you can see by the amount of money that goes into marketing these securities that there's obviously motivation outside of the betterment of mankind. So I think once you get a bit streetwise in the markets, it's not going to take long to make that kind of problem just a thing of the past for you. That's something that people worry about. Mostly they're usually older individuals who just have very little understanding of the modern financial world, and they might get something in the mail and the whole Jordan Belfort thing. But he's famous now, and most people are aware of that stuff. And if you're going to steal, you're going to have to figure out something new.
Jordan Belfort, that was Wolf of Wall Street. I love that movie.
Yeah, it's amazing.
He was real life. So are there any other types of strategies we can apply in real life versus the trading game, which lasts for about 6 months before we start calculating the winners? So obviously it's a shorter time horizon, but are there significant differences in the trading strategy? And then I see maybe you can also incorporate, Keenan asked if the international markets, when you say more chilled out, is it volatility wise?
Yeah, volatility wise, they just have a lot more liquidity. So there's an inverse correlation between liquidity and volatility. the more people are involved in the pricing of any given asset, the more efficient that asset will be priced. If you can imagine that every single thing in the world that you could possibly buy is essentially a little auction where there's a buyer and a seller and they're trying to meet in the middle. The more buyers and the more sellers, the more likely to meet in the middle they are. The fewer there are, the more likely they are to move to the skews. And someone's going to overpay or someone's going to underpay. So large liquidity creates sort of calm markets for the most part. Also in America, they have large institutional shareholding. So you will have these guys are less easily moved by world events and news events than a retail investor who's quick to press the button. Then as far as your time horizon of your investments go, in sort of in a trading context, a few weeks is short term, a few months is medium term, and a few years is long term. And you get investment horizons which can last up to your entire lifetime. In the case of this 6-month trading term, you'll be dealing with sort of 2 quarters. Shares tend to move in quarters. They seem to have a good quarter, maybe a bad quarter. But you happen to be entering into what is not necessarily a very expensive market, is certainly a very extended market. We've had one of the longest consecutive winning weekly runs on the American markets for a very long time. I think it's like 13 or 17 weeks or something. This is, if you went to a blackjack table and you were throwing black or red, you wouldn't expect 17 consecutive particular colors or numbers. So it's unlikely, just generally speaking, for markets to rise for such an extended period of time. So you are coming into a bit of an adventure. The reason why I constantly reference American markets is because if they sneeze, the rest of the world catches a cold. So it's very important to keep, just for general trend direction or sentiment in the market broadly, just keep track of what's going on in the United States particularly. You don't have to look at things there are a lot of things which are actually they have very little effect on markets, like war and these kinds of things that you would think they'd have an enormous effect, but they don't. What really affects markets is liquidity. The more money is flowing into the system, the higher the stocks go. You need to figure out what is determining those factors. Cost of capital is very much impacted by the Federal Reserve's rate, just like we in our country are heavily impacted by the SARB's interest rate. It determines the cost of money. So if you're relatively sure that you can do well with your money, and most businesses are, if you increase interest rates, you stifle their ability to borrow money, which then stifles growth, job creation, etc. You may have reasons to do that. You might want to stop an inflation run in the country. So you may have printed too much money and now you have to take some back. So it's a very interesting game in that it kind of gives you a reason to read the newspaper and find out what's going on in the world, because now you've got skin in the game. And because, like I said, the platforms available to us in this country that were never available before, your tentacles can spread throughout the whole world, from your little bedroom, literally. It's extraordinary how much information we have access. Every single person sitting here now has access to more information than the most powerful person in the entire world had in 1990. You can do things in markets that were never, ever possible. So, like I say, very blessed to be born into this specific generation with this technology. You can really get a lot more than you deserve now.
Okay, so you mentioned that wars don't have the impact we expect them to have on markets. Can you like, for example, the Russia-Ukraine war, would you say that that was almost inconsequential to the markets, or did it impact some areas and not others, so that it wasn't really affecting the companies that are listed on the major indexes that really move the market? Or is it, was it just an oil push, inflation push?
Yeah, the media is very tricky in that they would draw a lot of attention, for example, to the Russia-Ukraine war, which is like the current hot war that everyone's like paying attention to. But we've got 42 hot wars on Earth concurrently, of which you're probably unaware of 38. So markets there's like a hierarchy in human civilization, and you get the people, and then you get the governments, and then you get the businesses, and then you get the markets. Markets are really they're sort of they're very, very difficult to move. We're talking about unimaginable volumes of money and information and incredibly vast institutions, the biggest in the world, far larger than most governments. Apple, Microsoft, these companies are 100 times larger than our GDP. It's unbelievable. So as terrible as it sounds, Ukraine, they do produce a fair amount of foodstuffs for Europe. And Russia obviously is the second largest oil producer in the world, second to America, with Saudi Arabia third. And they've managed to keep production going for the most part, and there's been very little impact on those things. So yeah, like I say, markets tend to rise over the very long term, and it would take an asteroid to stop it. But certainly, news events, even if exaggerated in their effect on markets, can have short-term effects on markets, which certainly give you opportunities to purchase stocks at slightly discounted rates to what you would have had the opportunity to do so had the event not happened. So it is useful in that way, but some kind of like ruin risk as a result of a war or something, maybe a nuclear war, but that would literally be what would be required to stop this monster from churning on a daily basis, especially given the just inordinate amounts of money. The United States has essentially doubled its money supply, 40% increase over the course of the last 3 years. So you can imagine that that's got an enormous inflation push effect. It can ultimately have deflation effects and then cause this sort of stagflation in the economy. And Japan got into a very similar situation in the many years ago, and they took 20 years to get out of it. So, but that's not going to affect you necessarily in the next 6 months. Just a bit of context. I just want you to understand the nature of the context that you're buying into. Because if you go in thinking that you're going to probably see sort of a 0.5% change in share price on a daily basis throughout, you're probably going to be quite surprised by how much of a change you see, especially on South African markets. So ready yourself for that, but remember it's an incredible opportunity because, you might see a share dropping by 15, 20, 25%. Don't be alarmed. They do that. There's no way of knowing whether or not they will or not. It's just a case of being prudent in your risk management. Don't overinvest in any particular stock, but also don't overly distribute your money, because if you have a large profit on a 5% of your holding, it's not actually going to move the needle. So trading is a constant process of optimization and learning, where you get to know how much you want to put into each share, how much it affects you emotionally. You learn how to either utilize and focus or drive that emotion out of you. It's an incredible experience that will teach you so much about yourself and give you every reason to learn about every different thing. The market is incredible because it's like the currency. It's like the currency of mankind. It is your share price. It is the share price of the sentiment of the people in the world at any given time. and it moves in lockstep with the psychology of the entire human race, all at the same time. And because it's so vast, it's impossible to manipulate, and it's impossible to move for any institution of any size. So it really is free market capitalism at its absolute best. It is a place where you can go no matter what your race, your age, your financial situation. If you go in there and you put $1,000 into something, they don't know who you are. They don't know where you're from, what you believe. They don't care. It's totally fair. And that makes it rare in the world. It's also not subject to the normal commercial business laws that you'd be used to experiencing, where you've got people problems in your staff, or you've got, the car breaks down, or the work bakkie breaks down, or something like that. These are higher places. They go by a totally different set of rules, and they aren't subject to the normal economic laws. These are things that can rise by thousands of percentage points. They can you can use synthetic derivatives to magnify their power. You can produce profits from share prices dropping. It's fungible. It's binary. It's a lot of nuance to trading. And you guys are going to university to learn about how things function and how to build them, and these are the guys who got it completely right, to the point where they were able to sell it out into the free market. So they really are incredibly hardy businesses. You'll learn everything about accounting. You'll learn everything about fundamental analysis. You'll learn also the various techniques like technical analysis. You can be a quantitative analyst. You can be any number of things. And I mean, on a professional basis, these are the highest paid people in the world. They probably do the least work as well. These hedge fund managers and fund managers. So it's really an incredible science. And I've always been of the view that you can learn the whole law of South Africa if you wanted to. If you took the time and you had nothing else to do, you could learn it. You can't learn this in 20 lifetimes. And that means that for the rest of your life, you'll have an endless source of passion and energy and learning that has the incidental byproduct of producing real money that you can spend on stuff.
That's awesome. Okay, so Keenan's also asked, so especially now that we've been in a bullish market, like you described. So for the last, 10, 15 years, the market has pretty much gone up. Even if we've had some slight downturns during COVID, we still recovered relatively quickly. So everybody is telling us, I see even on Facebook, I get these messages about investing in Amazon or buying Bitcoin. And so everyone has an opinion in a bull market. So when the markets start to recess or things start to get a little bit troubled, who do we listen to? Where do we find the right news? Is there information or is it just strategy and tactics at the time?
Yeah, I think chasing news and is not really going to end up being a sustainable policy on the long term. You need to have a process, a set of rules, a discipline. It's extremely heavy on discipline. That's one thing about trading. You cannot miss the trades you want to make. You cannot be forced into trades you don't want to make because you don't have enough cash in your portfolio and you need to sell this to save this, that kind of thing. So in a lot of ways, you have to be quite practical about things. But you can do a lot with a little here. But I'd focus more on process than trying to keep up to date with current events. Remember, we're like little minnows, there's some guy sitting at Goldman Sachs right next to the stock exchange. His brother runs the SEC, and he's the guy getting the information. So by the time you get it here on the bottom end of Africa, it's old news. That ship has not just sailed; it's sailed, come back, and sailed again. So trying to have like an information edge will never be your way unless you one day end up at Goldman Sachs. What you want to do is you want to do the best with what you can. What you can do is you can think practically, prudently, with logic, and believe it or not, that'll set you apart from 99% of the crazies that are in that place, because they will do the strangest things. They are so reactive, it's unbelievable. And if you are just slightly less reactive, slightly less sudden or quick to move, you think that's a strength, but it's actually not. If you get moved in your opinion by every little piece of news, you're going to end up just treading water all your life in markets. You'll just end up paying commissions for a living. What you want to do is you want to have a high conviction, well-informed view and stick to it. If it's a contrarian view, that'll probably be very helpful as well. For the most part, shares that have gone down for a long time turn up, and vice versa. So, yeah, it's a lot of learning, but very much in your control. You can, like I say, you can invest any amount you like in the game, and you can invest any amount that you like in each real life stock eventually. But you can do it. The game does put you under a bit of pressure, which is quite nice. It makes you feel the need to buy those shares. But once you get that feeling, and you know what it's like, and you know how it makes you react as you get to know yourself as a trader, your performance will just increase consistently over time if you keep learning and just keep disciplined. And then I see that also you've asked about where you can get finance news. We have MoneyWeb in South Africa, which is sort of locally focused, which is sort of the preeminent news. We also have Business Day TV, which is on DSTV. It's also on YouTube. They put every video they make is on YouTube. And they give also detailed commentary on South African stocks. I strongly suggest that you watch a show called Stock Watch on BDTV. It's channel 412. It's also on YouTube, as I say. And on a daily basis, they give a summary and a rundown of all of the most important news events in our local stock market, to which you will be exposed in the trading game. And you'll be able to get a sense and maybe an idea of, hey, that's a good idea to look at that one, or maybe you'll learn something about a stock you already own that's a legit piece of information that you need to know about, may change your view on your share, not on a reactive basis, but just a fundamental piece of information might come to your attention that makes you either make a trade or add a trade to your watch list. And that can be the difference between a great year and an average one. Also, very importantly, what those shows do is they give you a sense of what other people are thinking. Now, that's not useful because you want to do what they're doing. It's useful because they're the other players on the board, and it's very useful to know what they're thinking. If they're all crowding into a particular stock, and you're seeing nothing but positive commentary on something, you might want to get a bit nervous. Or you see constant negative commentary on a company which you feel has a decent brand and has decent potential. Even over the durations of this trading game, you will make considerable returns if you manage to buy companies that just a bit oversold. You should see returns within a matter of weeks to months if you can push through the sort of propaganda you see from both sides on any given stock, the bulls and the bears. And when you see through that mist, you're going to have a heck of a lot of fun.
Okay, so bulls and bears, does that refer to the markets?
Bullish people are optimistic about markets, and bearish people are pessimistic. Because if if you can imagine how a bull attacks you, it lifts its head and it hits you, it's lifting things up, and a bear hits you downwards and knocks you into the ground. So that's, I don't know why they use those, but it's just what they went with that day.
All right. So how often does the market actually go up versus coming down? Is because we've given our, just to provide some context as well, we've given our traders the opportunity to both take long positions and short positions in the when they're choosing their JSE top 40 shares. So could you maybe just allude a little bit more as to how that sort of works? How often does the market go down, or are we still in a bull run?
Okay, so the market, it definitely has a very broad upside tendency, and over 100-year time horizon, it would be virtually impossible to lose money on a long-term hold. But over the short term, obviously you get a lot of volatility. We've had many sell-offs that were in excess of 30%. We've had 80% sell-offs in markets in history. We've had 10% market down days, the entire stock exchange. So, but these really are outlying events. Ultimately, stocks are powered by profits, which are constantly rising overall in the index because of inflation. So, if for no other reason, at least stocks keep your money real over extended periods of time, because it's those very companies that are selling you the inflated goods that you are referring to as inflation. So yeah, you're definitely swimming against the stream if you short stocks, but it certainly has its place in the portfolio of any person, in my opinion. I strongly believe in it. If you've got absolute long exposure and you're just hoping everything's going to go up forever, you're going to be disappointed, because you're going to experience periods of time that can last for a decade that are mostly downwards. And wouldn't you like to capitalize on that? At the moment, guys are bringing out quite a few shorts, some of them to protect profits they've already made, and some of them speculating that markets are going to come down, that the Israeli conflict is going to escalate, or the Russian conflict is going to escalate, or, I know that Trump's nomination is a big deal in America. It's going to be a very big deal for markets. It creates, the polarity in the American political system at the moment is such that the policies of the incumbent versus Donald Trump are quite different. So you could see a lot of volatility in the coming months. And again, opportunity, but potential risk. But, it's a great time to learn.
Okay, so speaking about the US elections, we're also having our local elections. And as Amanda has pointed out, do you think that there will be a big impact to our South African JSE market due to these uncertain times that we're facing in our election process?
Okay, that's a great way of framing it, because certainty is what it's all about in markets. Markets don't care about news being good or bad if they know the news. If they don't know the news, it's bad. So a situation, for example, where, let's say, for example, the ANC wins an outright victory and doesn't have any form of coalition government, that would actually enhance stability from the perspective of traders, because there's less change coming. There's less ANC wouldn't have to ask permission to do something. You could be fairly certain that they're going to continue to do what they're doing. Now, you might not think that what they're doing is good. You might think it is bad. You might think it is good. Who knows? But the market knows that things aren't going to change. And that's infinitely more important to markets. Policy direction and policy certainty and line of sight is much more important than bad news like Ukraine and Russia are going to war. So that's the same kind of line of thinking. You don't necessarily have to worry about the magnitude of the problem. How much of the problem is known how much of it is quantified. And then the market, which is a giant weighing machine and a voting machine, tries to efficiently price that event into the global share prices. So in South Africa, an election could have a very big impact on our stock market. It also impacts our currency, and our currency impacts our stock market. So you get a lot of different interconnected effects where you could see counter effects, you could see enhancement effects. But I think, if all goes relatively well and there isn't too much election-based violence and all of that, any intimidation or any of that crazy stuff, then for the most part, it doesn't much affect markets, like I say, especially if the markets already have a sense that they know what's going to happen. Then you might expect this huge event and it becomes a big nothing burger because the market already priced it in. Remember, the market is a discounting machine. So it's usually about 6 months ahead of time. And the only time that you really see a lot of volatility is if something happens that no one saw coming, like a black swan event. Then you see a big move in markets. But yeah, it's hard to turn that ship. It's $600 trillion.
$600 trillion.
Yes, which is more money than all the money in the world times 10, because the equity markets include the options markets. And the options markets are the largest securities asset class in the world. You get very big markets. The biggest asset market on earth is the Chinese property market. It's twice the size of the US property market. China has also created a lot of problems for itself lately. It's really struggling. They've very heavily invested into property and have massive overcapacity in China at the moment. They have so much excess capacity in China at the moment that they could house every single citizen in France in their empty buildings. So their property market's experiencing a lot of challenges, and it's bringing down their economy. And their economy is the biggest buyer of everything in the entire world. So especially what South Africa sells, like manganese and gold and platinum and all sorts of these manufacturing materials and commodities, even food. They produce a lot of chips. Microchips. They're an incredible place, but they've been powering global growth for about 10 years, and now they're starting to sort of teeter off. So the world is always looking around for something new to focus on. At the moment, the flavor of the day is AI. It's resulting in some incredible, crazy moves on American stocks, on certain companies like NVIDIA and other risk assets. But if you can preempt those events, you can make quite silly amounts of money. Some of these companies are up 800, 900% over the course of 12 months.
Goodness. Okay, so if we are about to enter a recession, say hypothetically, or if the market is uncertain because we have uncertainty in either our elections or the US elections, or the Chinese start to stagger, are there any industries that tend to perform better during recessionary periods, or any sort of shares or industries we should look out for?
Well, you can get you would simply think of a consumer is probably going to suffer in a recession. They're going to lose their jobs. So you would look at retail shares, for example, your Woolworths, your Truworths. People are going to have less disposable income. You might want to short those companies. Maybe you want to buy famous brands because you think that all of these sad, poor, depressed people are going to buy more fast food. There's a lot of ways you could play it. You also get companies which are relatively unaffected by that kind of thing, like hospital groups. It's not like you're going to decide not to get sick because it's a recession. So certain companies are like utilities, allow you to get a little bit less volatility. But then obviously on the good days and in the good times, they're not going to rise as much. So you can practice with the stocks in the JSE until you find the sectors you prefer. Or, if you're going to buy platinum shares, you're going to see movements of 25% a year at a minimum in either direction. And you might see some of those movements in 2 days. They might move 25%. But if you buy British American Tobacco, which is a giant conglomerate that's been churning out cigarettes since the beginning of time, that thing is paying a very decent dividend, but it's not really experiencing any sudden massive changes and variability in its customer base or in its revenues. So a much less volatile stock. But with less volatility comes less opportunity to buy it at a discount. So if this trade, for example, was consistently moving higher, but on a relatively, chilled basis, it's not going too crazy, you're never really going to have an opportunity to buy it at a really wonderful discount. So if you're happy with that and you're going to just buy something that you feel is going to appreciate at a reasonable pace in a reliable fashion without causing you too much stress, then you'll buy those kinds of companies. But I would suggest in the case of this competition, those kinds of companies probably not going to bring the win. You need to get a little bit gutsy and buy some stuff that's had a hard time lately, or if you're some kind of momentum or trend tendency to you, buy something that's really running hard and hope it runs harder. Because, like I said, the terms you're dealing with here, 6 months, you're going to have to be quite nimble and you're going to have to be quite committed. There's, time is very forgiving in markets. You don't have that much time. So you need to be quite selective.
Okay, I noticed that gold has had quite a nice bull run recently, but platinum and palladium don't seem to be moving in the same way. And yet, generally, the metal prices are related to each other. So, is there a reason, or can we account for that sort of,
100%. So, different metals and commodities, they give traders and economists, we use them as benchmarks for certain things. So, for example, copper is called Dr. Copper in markets, and copper is reflective of economic growth, because the higher or faster your economy grows, the more copper you're going to use. And it's relatively simple to do the calculation of how much your copper growth demand or your copper demand growth is going to change by, it will be roughly in lockstep with your economic growth. So in times of good economic upliftment, copper tends to do well. It also will go up on the electric vehicle theme. Whereas platinum is going down, for example, on the petrol vehicle theme, because it's losing favor at the moment on a thematic level. This isn't it isn't an indication that it's losing it in real life, but the perception in markets is that gold is an inflation hedge. So whenever we fear inflation, traders will run to gold. They think that oil is a hedge against the Ukraine-Russia conflict. They'll buy oil. So it's always like a story, and they all tell themselves a story, and you'll get told a story on TV, and you'll be told a story on YouTube. And people use these different commodities as proxies for a view. For example, our currency, the Rand, you get you get two kinds of currencies. You get emerging market currencies like ours, and then you get developed market currencies like dollar, euro, etc. When the market is having a positive feeling towards emerging market currencies, the South African currency is the currency everybody trades in the world. It's the proxy for emerging market currency risk. They don't go to the Brazilian real. They don't go to Mauritius. They come to us. That's what we are to them. That's why we have such a volatile currency. It's very little to do with what we're doing. That's just what the markets have decided. So same thing with gold. Gold is really rising very well. It's hitting an all-time high on a daily basis for the last few weeks. And that's because same thing I told you earlier about the money supply and the printing and interest rates have been going up, but they don't seem to be stopping the inflation. So traders are saying, hey, I'm going to buy gold. At least that'll retain some of its value. And they're selling platinum, perhaps because they feel like economic activity is going to drop. And platinum is used in jewelry, but it's primarily used in catalytic converters and directly involved in automotive production. So that's obviously very linked to global economic growth levels. And every single car has to use it. So these themes create a sort of an overall agreement between traders. And depending on what the real world news events are, they go to that specific commodity or instrument to reflect their opinion on the matter.
Okay, guys, I don't know if there's any more questions from your side. I think we've got about 15 minutes left before we close up our session, and before I keep asking questions, if you have anything to add. Other than that, can you maybe, I know I've heard of a few stories, but none have interested me as much as GameStop that happened recently. And that was, it seemed to be about trend and sentiment and just almost activist investors all getting together on a social media platform and then actually managing to move the needle. I'm sure it's because GameStop was quite a small share and had quite low liquidity. But are those the requirements? Do you need like this massive sentiment movement by a social group?
What happened with GameStop was similar to the pump and dump principle, only they sort of reversed it and used it against big institutions in America. So it's beyond the scope of this explanation, but in order to be short a stock, you essentially owe it to someone eventually. So what happened was a bunch of large American hedge fund institutions, they had shorted GameStop. So they owed a lot of stock to a lot of people. And the GameStop guys, they realized that due to the fact that the shares liquidity levels were so low, and that these guys were so heavily short the stock, if they could just move the needle a little bit, they could essentially create a chain reaction that would force those companies, those large institutions, to buy the stock in order to give it back to who it belongs to. And it turned out very successfully. They caused this nuclear reaction in the share price. The dominoes started to fall, and the next thing you had these hedge fund managers fighting to buy the stock, which obviously then drives the price up tremendously. And then the GameStop shares that were originally held by the Reddit guys who'd originally done this were then sold back to the hedge funds it was beautiful. But unfortunately, it will very likely never happen again, because it was a once-off exploit that the guys made the best of. But I think a lot of lessons were learned there. But that kind of thing, I mean, that's original thinking in a financial market that's 1,000 years old. I mean, that's fascinating, and it's an example of how the little minnows can come together and move proper money and like seriously affect major institutions. And that's like going back to the market's very fair. The market lets you have a good shot, even if these folks are very well informed, very well capitalized. You're only one clever thought away from taking their money, and there's nothing they can do to stop you.
Okay, so I also read a fascinating statistic the other day that 94% of hedge fund managers can't outperform an index. And but people like Warren Buffett managed to do it. What is their secret? How do they continually outperform a market index, which is so beautifully, dispersed? And it seems to take advantage of all like risk aspects, because essentially you eliminate the individual risk of the company and you're only working with the systematic market risk. So
yeah, Buffett is an amazing guy. He's quite anomalous, but he has just applied basic and good principles over the very long term. His skill is that he's really stuck to it. He's held some companies for very long periods of time, but he bought all of those companies during difficult times. He owns Coca-Cola. He bought Coca-Cola. I think it was in the 80s, in the 70s, when they changed the formula in error. It turned out to be a disaster from a marketing perspective. They changed it right back, but by that point, the stock had collapsed over the course of 1 year. He bought, I think, $500 million worth of it back then. So that makes him head honcho now. He owns many companies in that. He simply applied a buy great companies whenever they have a terrible year approach. He's got a big focus on management. But he's not the only way you can do it. I mean, there are many guys. Jim Simmons, there are countless hedge fund managers who have beaten markets consistently, but not relative to the number of people who've actually traded markets. Even the statistics for retail traders are actually far worse than even the fund managers. Things like options have like closer to 97% failure rate for the investors. And I know I don't want to scare you away, but what's important to remember is that the same amount of money is still in the system. So if you think that you have the potential to be in the top, say 10 or 15% who do make money, that means you will be sharing the 100% of the money. So, you can see it as a challenge and an opportunity, or you can see it as a reason to not give it a shot. I would see it as the former. I really think that you're going to have, you guys are in a wonderful position. You're going to be well educated. You've obviously business-minded professionals, even at this point of your studies. So you've every reason to end up in the winning 15%. And then you will have access to the 100% of the money. So I see it as more of an opportunity. It can be quite concerning, you wouldn't want those kind of stats if you're an astronaut. But like I said, the market's very forgiving. You can go in $50. You can mess around with a few thousand rand over the course of an entire year. You can continue to involve yourself in these mimic experiences like this brilliant application is for this contest, and you can learn at any scale you like. You want to okay, let's say you're going to lose $50. And then next thing once you've perfected your process, you can go out there and invest $100,000. It's totally scalable. You can do whatever you like at your own pace, and that's just gives you all the time in the world. Especially, you guys are relatively young.
Okay, Keenan. So I think this is our third year in a row that we're running it. Second year that we are personally taking it on. So hopefully, yes, absolutely. We're looking to run it next year. That's the whole idea behind building the application, was so that we could, like Michael's pointed out, mimic what you would be seeing on an easy equities platform or on a banking platform where you could trade. So we're trying to give you the best, most realistic and pragmatic experience to sort of prepare you for trading yourself. So if you have any suggestions or comments, any of you guys, please just let me know. We want to make the application as useful as possible so that we can run this competition a few, years in a row, so that every year we have the opportunity to learn new things, maybe even build a bit of a trading community, amongst us. If you guys are in the top, once you graduate, you're in the top 6% of the country already. Very few people actually get degrees in our country. So you already, like Michael pointed out, you have every advantage. So we'd love to reinforce, and give you the opportunity to build the skills you need to build a sort of passive income for the rest of your life. Okay, guys, it's our last 5 minutes. Does anybody have any questions? Otherwise, Michael, do you?
Yeah, I just wanted to say, with regards to what you were saying now, remember something. Every single wealthy person on this planet, and I'm talking about properly wealthy, I'm not talking about movie star wealthy, they have 99% of their money in stocks. Bill Gates, Elon Musk, Warren Buffett. We're not talking about, Tom Cruise making a few million a movie. We're talking about people who've got $200 billion. What chance do you have of reaching your highest financial possibilities if you have no exposure to the thing that the richest people in the world always have 100% of their money in? But just ask yourself that question.
Wow, that's so insightful. Okay, so even if we're, it takes a few years in order to get to the top 10%, at least you're starting early, and you guys have the advantage of decades to get it right. And you only really have to get it right a few times.
Yeah, once the bug bites, you'll find that it's also not labor. It's not an effort. It's not work. You will enjoy it. It is passion. It is fun. It is news. It is entertainment. It is emotion. It is getting to know yourself. We're not talking about digging a hole here. You're going to really, there's a heck of a lot of conduits to pleasure and happiness and fulfillment and enrichment and financial enhancement and intellectual advancement, and you're just going to become a better person, really. That's I've known many hundreds of traders in my life, and every single one of them loves it with all their heart.
Yeah, absolutely. Okay, guys, if there are no other questions, thank you so much, Ken. Yes, absolutely. The 6%, I think if you include, say, certificates, it moves to about 11%, but it's quite, in fact, if you go even beyond that, I think the number of people with matric certificates in our country is about 33%. So it is, in this country, it is the best market. Well, we're in the top 20 largest markets in the world. So every opportunity, and you guys have the advantages. So we're here to support you. If you have any other questions, please send me an email, or you would have received a link to our questions and queries form. Please just drop us a line and we'll see what we can do to help you guys. And we will be having another session next week, Friday. So if you have any questions you'd like Michael to answer during that time, please just let me know and I'll prepare it ahead of time. Otherwise, have a lovely Friday evening. Thank you so much for joining us this evening, and have a wonderful weekend.
Cheers, guys. God bless.
Thanks so much, Michael. Thank you, guys. Bye.